Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China RES Gas Interim Report. China Resources Gas Group Limited offers a diverse range of businesses and services, including sale and distribution of natural gas and liquefied petroleum gas for residential, commercial, and industrial use, construction of gas pipeline networks under gas connection, contracts sales of gas appliances and related products, design, construction, consultancy, and management services for gas connection, projects, operation of natural gas filling stations. These services are provided through 5 main segments: sale and distribution, gas connection, comprehensive services, design and construction services, and gas stations. The significant decline of China Resources gas stock price, a confluence of factors over the past year. China Resources Gas, CR Gas, stock has experienced a substantial decline of approximately 35%. This downturn can be attributed to a combination of factors that have collectively contributed to the company's weakened financial performance. The domestic economic slowdown and weaker earnings have been major concerns, with reports highlighting near-term pressure amid a domestic slowdown and weakness across all segments in CR Gas earnings. The reduction in analyst price targets has also played a significant role, with multiple decreases throughout the period. Furthermore, China's decline in liquefied natural gas (LNG) imports, driven by milder winter weather, sluggish industrial growth, and increased domestic production and pipeline gas imports, have further impacted CR Gas stock price. Geopolitical risks, including escalating trade tensions with the United States and tariffs imposed on U.S. LNG imports, have also contributed to the decline. Additionally, challenges in gas storage infrastructure and increased competition from domestic production and pipeline gas imports have posed significant risks to CR Gas supply stability and pricing power. While an upgrade by HSBC in September 2025 provided some respite, the preceding negative news and market conditions were the primary drivers of the significant drop in China Resources gas stock price. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth drivers: organic growth and expansion into new provinces, increased gross gas sales volume and growing customer base, government measures promoting natural gas development and utilization, optimization of energy structure, driving sustainable growth of natural gas consumption. Revenue decline drivers: decrease in proportion of revenue from gas connection business, revenue decline in certain regions, including Qinghai, Gansu, and Xinjiang, decreased residential, industrial, and commercial gas sales volumes. Comprehensive service business revenue decline, neutral or mixed drivers: no significant change or decrease in pipeline usage, increase in number of customers. Net income and profit margins experienced significant declines between 2024 and 2025. Net income decreased by $0.06 billion, from $3.46 billion to $0.4 billion. Profit margins also suffered, with net profit margin decreasing by 1.9 percentage points to 6.7% and gross profit margin declining by 1.5 percentage points to 17.1%. The reasons behind these changes are not explicitly stated, but a decrease is mentioned on page 31 without further explanation. The company's financial performance indicates a shift in its operating cash flow. While it generated $42.5 billion in operating cash flow in 2024, this figure decreased to $30.1 billion in 2025. However, the net cash from operating activities also shows a positive trend, with $8,942 in 2025 and $4,252,981 in 2024. Despite the decrease in operating cash flow, the company is still generating positive operating cash flow, indicating a stable financial position. The company's debt level and interest expenses have undergone significant changes in recent periods. In terms of debt level, the total borrowings increased by $0.95 billion, representing a 12.8% rise from $23 billion to $25.95 billion. However, this increase was partially offset by a decrease in non-current liabilities of $0.33 billion. As a result, the overall debt level has remained relatively stable. On the other hand, interest expenses have decreased significantly. Bank and other borrowings saw a 44.8% drop in interest expenses, while lease liabilities experienced a 33.1% decline. Medium-term notes also showed a minor decrease of 0.5%. Overall, interest expenses have been reduced across various sources, indicating a more favorable financial position for the company. The company's financial summary reveals a mixed performance across various segments. Notably, the design and related products segment saw significant growth, with an increase in segment results by $4,019,596 and external sales rising from $809,546 to $3,016,023. Comprehensive services also experienced growth, with an increase of $589,103 in segment results. On the other hand, construction services saw a substantial rise in total segment results by $6,668,329. However, some segments underperformed. The gas connection segment reported a decline in segment results by $175,338. Unfortunately, there is no clear indication of performance improvement or decline in the gas station segment. Management is optimistic about the company's outlook, citing minimal exposure to foreign exchange fluctuations. They also plan to invest in 5 city gas projects, totaling approximately $0.09 billion. Furthermore, the group has emphasized its commitment to environmental, social, and governance (ESG) initiatives, prioritizing material issues and transparency through regular reporting. The company has made significant acquisitions in the past year, totaling approximately $0.45 billion. The key acquisitions include investments in 5 city gas projects worth around $0.09 billion and pipeline construction and related facilities for expanding its gas operations at a cost of $0.36 billion. On the other hand, there have been no divestitures disclosed by the company. The company has a history of paying dividends to its shareholders. In fact, it has been consistently paying dividends in Hong Kong dollars, HKD, over the past year and interim periods. Specifically for the year ended December 31, 2024, the company paid $587,770,000 as a dividend, while an additional $689,906,000 was paid as an interim dividend for the 6 months ended June 30, 2025. These payments demonstrate the company's commitment to returning value to its shareholders through dividends. That concludes the financial summary for China RES Gas. Feel free to comment below, and I will be happy to answer them when possible.